taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the Total Money Management Podcast. We're going to be going through the week that was June 24 to 28. How are we going, gentlemen?
Excellent.
We're back. We're back in your ears.
Beautiful weather. Beautiful weather.
We are back. Before I get into the big issue, we'll kick off with the key points. So we're going to be talking about consumer confidence, tax cuts are coming, tech mania, inflation not good, household wealth, wage pressure, and the capex boom.
Bit of a mix there. Bit of a
healthy mix there. But look, we'll start with the big issue anyway. And like we've discussed a bit recently, what happens with the tax cuts and wage rises is going to largely determine how the economy performs over the next 6 to 12 months.
Yep.
After that, we predict that government spending will kick in and boost the economy prior to the election. And we went into a bit more detail on that in the most recent coaching call.
We did. We're all going to get rich once Albo and Chalmers start blowing the budget out. 28 billion. It's coming, folks.
And then the median house price will go to 17 million.
That's right. The average Sydney price will be 45 million.
Looking forward to it.
Speaking of elections, have you fellas been watching the old boys go at it yesterday?
Now, bearing in mind, this is coming out after 2 weeks after the Trump Biden.
Well, they're on a. Oh my God, it was in my opinion, an embarrassment of a debate.
I didn't watch it.
The only thing I've watched is someone posted 5 things of Joe Biden falling over, like walking up the stairs and
right.
Like,
yeah. The thing that made me laugh and turn it off in embarrassment was and we won't spend any time on it, but Trump talking to Biden about how rubbish his golf handicap was.
Oh, yeah.
And Biden's like, no, I'm off 6.
Mate,
this
6
is a national debate.
These are the prezzes.
Hundreds of millions of people watching. Oh, yeah, I've got a golf handicap of 6. And Trump's like, no, you haven't. You got a shit swing.
Yeah. You couldn't hit it 50 metres or something. Meanwhile, we got
serious?
We got wars breaking out, COVID raging, the environment collapses. It's like, what's your handicap, you loser?
Man.
Listen to what the prez says.
Okay.
So
just if I can just get in there on basically, I think as we've talked ad infinitum about tax cuts and stuff. I think with inflation rising, if rates go up, everyone's going to start paying down debt. I can't see, and I think I spoke about this a couple of weeks ago. I look at people in 3 groups. You got the low income, pardon me, but they're poor. They will spend everything they get just to keep going and surviving. It's not a choice for them to save money. They've got to spend everything because it's rent and really basic food, right?
Yeah.
Then you got the middle class, which is quite wide, and within there you've got people who have got, say, an investment property and they're paying an extra $300 a week. They're the ones that are going to say, okay, we're doing all right. We think it'll be all right. We got an extra $100 a week. Let's spend 50 of it, right? Or let's, spend 100 of it.
Yeah.
Alternatively, they'll say, let's spend nothing. Let's just simply bank it because rates are going to rise further and, we're not going to adjust our lifestyle. And in fact, we may even cut back because we've got used to not buying the Dorito corn chips anymore. So therefore, why should we buy them if we got an extra $50? Let's pay down the mortgage. And I think we said a few weeks ago, there was something like 80% of people were basically saying, yeah, give me the money so I can pay down the debt.
Well, that's exactly what Elle and I sat down, my partner and I sat down last week and said, okay, this is how much we're probably going to get back in at tax time and we're going to pay it all down the debt. We're going to be debt free for next year.
Right.
That's one example.
Yeah. And I'm not being rude, but you're not exactly on struggle street, are you?
No. We're well and truly middle class.
Yeah, and that's what I mean. There's people like, now times it by, 3 million. Yep. Right? People sitting there going, okay, what do we do with the extra 120 a week? We pay down the debt. Okay. So, and the wealthy will just sort of not bother spending it anyway because it's,
it doesn't make a difference.
Well, they get an extra $150 a week. It's like, oh, really? Didn't notice, right? I'm not being rude, but just saying it doesn't matter to them. They're not going to go, oh, I'm going to upgrade from a sports girl to a Louis Vuitton or something, right? They're just going to keep. They gather assets. They don't spend into the economy. So it's going to be basically a portion of the poor that will spend it. And even a lot of those people have got debt, which is, buy now, pay later or credit cards, so they may spend it down. The Reserve Bank is basically, the Treasury, and the Reserve Bank are basically saying we don't expect a big spend from it. And so they, I think, realise that people will be paying down debt, which means there's not going to be any boost to economic growth.
Interesting.
Depressing.
Yeah.
Look, at this point, it just feels like realistically with the rate, everything seems to be going up.
Yeah.
This won't make a lick of difference.
It probably, it's not that it won't make a lick of difference, Tom. I think it's just, it might make it not as bad, right? Instead of saying, oh, Jesus, we've been hit by another $120 a week in the rate rise, this point might be like, oh, well, we got 100, we got to pay 120, we're only $20 worth off. But the point being, if everybody's $20 worse off, then the economy is continuing to sink, right? And that's why I'd say there's only two things you really need to look at. Government deficits, are they spending more than they're taking in? And borrowing. Are people borrowing more? Because that's what drives the economy. Because if there's only you, me and Jacob and there's the economy's worth $100, well, unless there's more money coming into the economy, the $100 is just going to be Jacob's got 50, you've got 30 and I got 20. And then at the end of the year, Jacob's got 45, you've got, 25 and I've got whatever's left over. And then the year after that, it changes. So the only thing that grows the economy is saying government says, oh, Tom, Steve and Jacob, we want you to build a bridge. Here's another $500. Or you guys go out and say, I'm going to start a business. I'm going to borrow 100,000. That's the only way you can get new money in the economy, because you've got to remember governments are taxing, which is taking money out of the economy, right? So if the governments are taking money out of the economy, well, that means there's less money in the economy to spend, right? And that's what's been going on when governments have been running surpluses, because what that means is the private sector, i.e. businesses and you and I, and exports have got to make up for that. Well, the only way consumers can do that is by borrowing money, right? Or having a huge productivity increase, and we haven't had that. So that's why I'm really concerned, but next year will probably be better because Albo and Chalmers are going to go into deficit to, I think it's about 28 billion.
Yeah, 28 bill.
Right? And everyone goes, oh my God, that's terrible. It's like, dude, that's great because that money's coming to you.
They're spending.
That's exactly right. Right? Then you say to yourself, oh, hey, things are going all right. I think I might, I'll go and buy nicer bread or, steak, or I'll go and buy a better car, right? And generate economic growth. Yeah. But if you're paying down your debt, the last thing you do is you go, oh, let's go and leverage up and buy another car.
Yeah,
right.
And this is not us just making things up and with our wild accusations, as we quite often do. But the RBA,
speak for yourself.
The RBA, in its recent post, mentioned that, their statement really is saying that a higher than expected proportion of households will save their tax cuts. That's direct from the RBA's post-meeting statement.
Yeah. So that's what I mean. I think they know. I mean, God, blind Freddie can see that we've got the second highest household debt levels in the world, right? And, we talk about stocks going up the top, falling to the bottom, and the ones down the bottom going up to the top. Well, it's the same. If the government's not spending a lot of money, well, someone else has to spend, and it has to be you. And for the last 30 years and last 25, Australians have been borrowing their bloody heads off, and that's because the governments are trying to run surpluses, right? And so, and as I say, you get to the point where you go, Steve, dude, I just don't want any more money, and I'm going, Jacob, it's like borrow 1.5%. It's like I haven't got any more capacity.
Yeah, that's
when the music stops, and that's why I'm saying household debt at the second highest level in the world. Go and look at history. No one ever stays up that high. Why? Because you got to pay it off.
It falls back, yeah.
Right? You get to the point where you say, I just can't borrow any more money. And that's when prices fall, right? The demand for money stops.
Yeah. Well, look, in other news, the Nasdaq's now outperforming the S&P 500 by the largest margin in almost 30 years. And it's even surpassed the peak of the dot-com bubble now. So I actually haven't been tracking the Nasdaq. It's all been about the S&P for what feels like forever. But would that be led by things like Nvidia?
Yep, the big seven,
Big time.
Yeah. If you have a look at the dispersion, or the what do they call it? There's not the advanced decline line. The amount of stocks reaching a new 52-week high versus the amount of stocks reaching a new 52-week low, right? And what you see is there's a hell of a lot more stocks reaching the low than there is in the high. So basically the Magnificent Seven are responsible for all of the gains.
Yeah.
And that's really dangerous.
Well, that's what concerns me about Nvidia. Because I'm like, well, that thing's been an absolute runaway train. It's going nuts. They've got a great story. Obviously, it's a good company. But, at those kind of valuations, what happens when that starts to show cracks? Which, I think it has. I need to check again, but the other day
Well,
I
it
checked,
had some
down.
volatility
Last week, yeah.
last week. It had some serious volatility with a few. I think it had 3 down days in a row, which basically everyone there, that's the end of the world.
No, that's the bottom. Buy it.
Buy the dip. I think it lost 6% in a day and then gained 6% the day after.
Yeah.
Which, if we know anything, it's volatile at the top of a market.
Absolutely. Well, my theory is everyone's got their finger on the trigger.
Yeah.
Right.
They're waiting until then everyone will jump out at the same time.
Well, everyone knows it's overvalued, and what Tom was saying was it's a good company. Yeah, it's a good company, but as I said last week, but is it worth a sales ratio of 40?
Yeah.
When the average sales ratio is about 3.
It's still down 12.5% from the high.
Yeah.
And
Choppy.
someone bought it at the high. So someone's down 12.5% in comparison to, some people who bought it 3 years ago and they're up 85 zillion or something.
Yeah. Well, those
Same story.
And we all know the narrative. It's still cheap. Wait.
Based on a forward PE of 85 million.
It's still cheap. This is like buying Bitcoin in 2009.
Oh, God, please stop. I won't talk about property if you won't talk about Bitcoin. What about that?
We've got nothing to talk about then. There's no podcast.
And you can't talk about China.
Oh, well, that's it. Thanks for coming, folks. It's all over. Short episode. Righto, what have we got Wednesday? Inflation. Inflation's up. Everyone knows that story. Dorito corn chips, I went to the supermarket, $4.80. I'm still not buying.
Lucky you're rich.
I've swung to sweet and salty, some other crappy, highly ultra-processed food that my daughter loves, apparently, even more than Pringles.
Wow. Like the Coles version
Innovation,
of the Pringle.
mate. Innovation. Speaking of innovation, notice a little bit of the bit of a change in the format of the week that was,
Mate,
gentlemen.
I can't believe you found a border
There's
to
a border
start with.
now.
And this little the little
Cartoon.
you put in there.
Dash of humour,
I can't believe you even figured that out.
mate.
You can do this moving forward. You don't need me anymore.
Ah, well, that's what my ex-wife said. Righto, Thursday.
What's going on? Credit growth is slow. It's credit growth is slowing.
And she was right too, by the way. I didn't need her. Anyway, credit growth.
You put me off.
Household debt, look at that. Beautiful, rising.
Mistaken belief of many economists that a rise in house prices wealth.
Yes. Yeah, one of the things I want to mention, and I'm seriously here, is what people think if the price of their house goes up, that's wealth.
And we talked about this briefly last week.
Yeah, I'm richer because the price of my house went from 1 million to 1.1 million. So I'm $100,000 richer. You're not. You're not, because you haven't sold it, right? And this is, again, the problem of the way we measure things, because real wealth is generated by productivity, which is generated by business investment, right? Tom, you borrow $1 million, you start making widgets, and then 12 months later you go, Steve, it cost me 10 cents to make widgets. Now I've got a new machine and I can make them for 6 cents. So I'm being more productive. That's wealth. right? Wealth is not saying, Steve, here's a property I bought for $1 million. It's exactly the same property, and in fact, it's 12 months older, but you can have it for 1.3. Like, you have to honestly look at that and go, why the hell would I pay 1.3 for a house that you bought for $1 million, and it's exactly the same house, and in fact, it's older?
But a lot of people will.
Absolutely.
So if you sell
Well,
it,
in fact, they have, right?
that is wealth, right?
And they make money, but what I'm saying is, and again, this is always why I talk about time, because at some point that stops, you see, and you have to say to yourself, well, what's my chances of getting out before it stops? Now, lots of people will. I'm not arguing they're wrong, but I'm just saying that is not wealth.
It's not liquid. It's not cash flow. Doesn't make your mortgage.
Well, it's not productivity, Jacob.
It's hot potato.
Right, exactly. It's the Ponzi stuff. And like, I think I'm not sure. No, I didn't write it there. But you imagine if you bought a car, right, which is a consumption item, right, like a house. You live in a house, you drive a car. You imagine if I came to you and said, Tom, you are richer because your car is worth more money. You wouldn't go, yep, absolutely, Steve. Right? Because cars are a consumption item. They depreciate and they bring out new models all the time, exactly like property. Right? Property depreciates. They get better materials, better insulation, right? More comfort, more features, that sort of stuff, right? So it's illogical to say, Tom, why would I pay you more for that house simply because it was built 10 years ago, now it's 12 years old, but I'll pay you more for it. In my mind, that doesn't make sense. And that's partially a bit like why Warren Buffett is not a property guru, because he knows he knows it's not wealth, right? Wealth is buying businesses that make more and more cash flow. You can't do that with a property if you've got a loan against it and it costs you $500 a week and you're getting, $400 in rent. That's not productive. That's losing $100 a week. Right? That's what I'm saying. They're saying, Australia's wealth is now, I think it's like 14 trillion or something, but property is worth 10.7 trillion. Right? That's 5 times Australia's GDP. And the average is about 2. So again, that's when you look at all of these figures and say, this is batshit crazy.
Yeah.
And because they're counting it wrong, right?
Well, and then you open up all the arguments as to why that's happening as well.
Why? What's happening?
Why property is worth so much of the GDP?
Well, but it's why it's again the borrowing. If you borrow debt, businesses borrow money to make money, right? Yeah. That's the way it works. The bank will, if you went to the bank and you said, listen, I want to borrow $1 million, and they said, okay, so what's your business? And you said, well, look, what I'm going to do is I'm going to build this factory and I'm going to rent it out and the people will pay me $500 a week for the factory, right? And the bank says, okay, but you're going to give us $800, you're going to have to pay us $800 a week. So you're down $300 a week. If you didn't have a plan to say, yeah, but over time it'll be paying me $1,500 and I'll pay you guys $600 by then, so that's the productivity, right? The bank would go, well, mate,
it's not worth it.
If you're not going to be cash flow positive, we're not giving you any money.
Yeah.
Right? And that's why I'm saying if you look at it that way, what they do is they call it self-financing, right? So I borrow $1 million, I do a cash flow chart which says in 5 years I'll be making $3 million or whatever, right? Debt, unproductive debt is the stuff like property or buying a car. It's exactly the same thing. All you're doing with property is saying, I'm hoping that it will make some money in the future. And even one thing you've seen recently is some of the property experts are now sort of saying to people, well, don't think you can make passive income from property. Well, you can't if it's negatively geared. Mm-hmm. Right? The only way you can make passive income is by saying that I owe the bank $500, the property's worth $1 million, I have to give them $600 a week and the rent's $750. Okay, I'm making $150 a week. outside of the capital value, right? Increase. That's the only way you'll make passive income. Alternatively, you buy at $1 million, you sell at 1.5 and you've made 500 grand. Now, there's nothing wrong with that. But what I'm saying is people shouldn't mistake the idea of thinking that, you know, in 5 or 10 years' time, they'll be having, quote, passive income.
Yeah, well, the increased volatility of the property market. We know a few people that have been buying and selling every 3 years. And buying something at 700, flipping it for $1 million, buying something at $1 million, flipping it for 1.5. That can't go on forever.
Well, no, but there's nothing. And I think you mentioned it a couple of weeks ago, Tom. You know, where you were saying, well, Steve, there's been people who bought in COVID and they've made 300,000 or 400,000. And I'm not saying that's wrong. No. I'd be an idiot if I did. But what I'm saying is, like you just said, Jacob, it won't go on forever. And the problem is, as I alluded to with my friends in Sapporo a few weeks ago, the more you leverage up, you've got to get out of that space really quickly. And with stocks, you can at least go, this doesn't smell good, I'm going to sell. Right? Click, done, you're out of there. The difference with property is you've got liquidity, you've got transaction costs. If the market falls, you don't necessarily get buyers at the price you want.
Yeah, and we've also it's also people are jaded with the recency bias that like properties are going on the market and they're getting snatched up like very, very quickly.
Yeah.
So,
but
back to that conversation, right?
Yeah,
you can't see that that's a possibility.
Yeah. You can flip property. I'm not arguing against that because, I mean, we do it with well-to and stocks, right?
Yeah.
We buy stocks and we sell stocks. But what I'm saying with property is it's a lot more difficult because you've got transaction costs. The governments are now going after you, as we talked about it last week, right? The governments are now going after property investors, and property investing is big loads of leverage, right? If you leverage up and it goes wrong, then that's when it can be, life altering. You guys made penny stocks and you lost some money. It's a bit like, oh, bugger. But it's not like you went, oh, yeah, Steve, I bought a property. I got it wrong and it's 150 grand later and I'm still paying it off. That's, and that's what I'm saying. Look, that's what we've got coming because that's the way markets work. And as you said, Tom, last week, it goes twice as long as you think. Yeah, but it still ends. And, I'm not smart enough to know when it ends.
Yeah.
That's really...
Well, in more positive news, Friday's entry, nurses are in line for a 28% pay rise. I mean, that's a win.
Go boys and girls.
Unions are fighting hard in teachers, childcare, aged care to increase their wages, which probably will increase house prices again. So because they can pay more, but a big win. They need it. But I mean, a 28% pay rise might give someone an extra couple of $100 a week in the nurses
over 4 years.
Yeah,
4 7's 28, 7%.
Yeah. So,
but you've got to remember, and this is what I'm not. I think I talked about it in the video. People, you see on social, people go, "Oh my God, that's outrageous." Nurses getting, blah blah, 7%, and it's like, guys, they haven't had a fucking pay rise for 20 years. Like they're not even anywhere near what they should be paying.
Well, they've got
and they're the ones who you want them to be there to save your life.
Okay. It's the same.
Pay them lots.
Yeah.
Encourage them to stay.
Yeah.
Well,
everybody seems to think paying doctors is good, which is fine. But I think it's the same with teachers, police. Like I look at police wages and go, man.
Yeah, for the shit they have to put up with.
Oh, man. And teachers are the same. It's like, mate, I wouldn't teach a bunch of kids if you paid me 300 grand a year. It's a bloody nightmare. Right?
Yeah.
And the work they've got to do, the admin, all of that sort of stuff. It's just, oh boy, it's a tough gig.
100%. And you want them to have good work conditions when you're putting your kids through that system.
Yeah.
You want the teachers happy, so they want to do a good job.
Absolutely.
Well, to me, this is proving what we've been talking about, which big government's obviously coming back. We've been sitting in the private sector for so long, where this public sector has diminished over 20, 30 years and not been paid much because the private sector's been getting all the cash.
Yeah.
Whereas now it's like, all right, government's stepping back in. We need to get these people into a good home, good conditions to bolster the economy for the next 30 years.
Yeah.
So I think it's a good move.
Well, the more money you give people, the more they'll spend.
Mm-hmm.
right? So if you want economic growth, why don't we just give people more money? But that's not been the argument for 30 years. The argument, I can tell you, 30 years ago or 40 years ago now, was the trickle-down argument, which was, no, give the money to the rich people, they will invest it in stuff, and the money will trickle down. And it hasn't. It's trickled up.
Yeah.
Right? It's trickled up.
Because we're all greedy.
Reverse gravity.
Well, no. It's just that it's just people. Charlie Munger said, "Show me the incentive, and I'll show you the behaviour." Right? If you incentivise people to speculate in property by negative gearing, by giving all these tax breaks, by helping them with stamp duty, all of that stuff, guess what? People are going to buy property. Why? Because that's where the goddamn incentive is. Right? That's what I'm saying. And if you incentivise people to shift their company offshore, make it into a tax haven, get a family trust, all of those sorts of things, that's what people will do. We shouldn't really be shocked that corporate governance is really awful, right? Because they've made it really awful. So we can't, it would be silly.
They've incentivised it to be awful.
Well, yeah, it's self-regulation doesn't really work. Right, and it's as simple as saying, if it worked, we wouldn't have 63% of the population who are obese, right? Because you'd look in the mirror and you go, listen, I really need to lose some weight. Okay, I'll just do that, right? It's not the way it works. You've got to have, and I can tell you this after 61 years, you've got to have a regulation that says, Steve, you can do this, but not that, right? That's the way you do it. Because if you leave it to me, I'm going to naturally just drift towards where the incentives are.
Or the path of least resistance.
Absolutely. This is Zipf's law, right? Zipf's law, which was people take the path of least resistance, right? The path of least effort. Where do I go that's easiest for me? Right, that's where I'm going. Right, that's the path I'm going. And that's part of the incentive stuff, right? If it's easy for me to, speculate in property and that's going to make me rich, that's where I'm going, right? And that's the way it works.
All right, let's talk about CapEx, or capital expenditure, for those that aren't up with the corporate terminology. So US and Japan factory construction and in the defense sector, clean energy and industrial metals, is booming. Right, since 1993 up to 2023, there's been incredible amount of capital expenditure and investment in those areas.
Yeah, but look at it from. I haven't got my glasses on.
Just a modest 550 billion.
Yeah, but look at it from 20.
Yeah, like after 2018 to 2023, it's up probably
over double. Yeah,
double.
And that's a double in 6 years. So that's about 15% per year.
Yeah.
Right. So that's a lot of increase. And all of it's going into defence, the 4 Cs, right? It's all going into defence. It's going into demographics, semiconductors, right? Everything that we've gone, we're going to take that out of China and we're going to put it back in Minnesota.
Yeah. And it doesn't look like it's going to stop. If anything, it's only just started.
Well,
absolutely.
It can't really stop, right?
Oh, mate,
long way to go, man.
Oh, yeah. This is a decade journey.
Yeah,
you can't build half a factory and go, you know what? Nah,
we're done now.
We're done. I think we made
We'll turn it into a daycare.
I think we made a $600 million mistake there. Let's just leave it.
Yeah.
Right? That's what happened in some parts of, if you go into regional Japan, that's what happened in the mid-90s when the bubble burst. You go and have a look in regional Japan, right? And you drive through these cities, and I can't remember the one I went to. It was when I lived there. Might have been Okamoto or something, but they had a Sea World, right? It was seriously the most rundown, depressing place that you'd ever seen. Like, it had no capex spent on it in 20 years. And what had happened was, when Japan had the bubble, like China, they were awash with money, right? And so what did they do? So they just gave it to the regions to spend on the dumbest shit you could think of.
To try and boost growth, like what Australia are doing with the nuclear power plants.
Well, yes and no. what the Japanese were doing, because we talked about this the last episode, because they didn't want to transfer the money into yen and into wage rises, which would make them uncompetitive, what they did was they gave it to government to spend on, quote, infrastructure, right? So the government, when you're awash with money, you know this yourself, you buy all sorts of stuff where you go, man, that was a really dumb thing that I should buy. But you buy it because you've got the money. So the local governments in Japan would say, righto, we've got an idea. We're going to build a SeaWorld facility, right? And it's like, great idea. Here's $100 million because we got money coming out our ears. And like you say, it creates jobs and growth and stuff like that. And then when the bubble bursts and the local tourists go, well, we can't afford to go to SeaWorld anymore, that's when it sits there. And that's what you see in regional Japan. A lot of the hotels are really run down because there's not enough profit for them to reinvest to say, well, let's jazz up the rooms, right? Let's renovate and let's get some new services and stuff like that, because there's no growth in the economy. So everything just stays static at a depressed level. And that is because everybody went crazy borrowing money in the Japanese bubble, right? And then when the bubble burst, everybody, this is why I'm saying with Australian property, you get held, it starts to deflate and you go, hang on, I owe $1 million here. And now the property's worth $800,000. So do you cop a $200,000 loss, or do you think, well, I'll just try and pay it down and hopefully it'll come good? Japan's been doing that for 30 years.
Yeah, right. So they've all learnt the lesson that we've yet to learn.
Exactly, Tom.
Yeah, okay.
Exactly. Because, and like you were saying last week, nobody can see it, right? And I'm only saying it because I'm old enough to have seen it and have lived in Japan and stuff and know that the way that the economic structures work. And look, I can tell you, it's not going to end well. And I know people think, oh, that's a bit depressing, but I'd rather say to people, listen, you just need to be careful rather than go, oh, yeah, mate, it's all going to be good.
Yeah.
Because that's not the way markets work, is it? We know they go up and down. So, why do we think that we're any different over here when it's exactly the same? High debt levels, high borrowing, irrational exuberance, thinking, the world's fantastic. We're unique, right? Blah, blah, blah. And that's why I'm saying, when you look at the other countries, America, England, Canada, they're all having exactly the same problem. Huge inflows of foreign capital that blows up their asset prices, right? And then it stopped. And the Asian countries had that in the late 90s. That's what, you guys are probably too young, but in 97, 96 to about 98, 99, the Asian economies were hugely awash with money, right? And then it all went pear-shaped for them, right? That's what happened. And we're just repeating the same mistakes, right? But it's just,
So be careful. What we're saying,
well, it's human nature.
Is just take a minute, take a breath before you jump in, before you jump both feet in.
How much did Japan property drop by?
Oh, Jesus.
You can buy a 4-bed house about an hour out of Tokyo for about $50,000.
Yeah, but I don't know what it was.
Yeah, well, put it this way. They've spent 30 years getting back to value. So the property prices, look, don't hold me to it, but they'd have probably fallen in real terms. They'd have probably fallen 70% from the top of the bubble. That's like, as I said to you, the NASDAQ fell 83%. Right, from 2000 to 2003. Now, that is unimaginable, isn't it? Mm-hmm. If I said to you, listen, Tom, Nvidia is $800, it's probably worth $50. You'd go, oh, Steve.
Oh, your $1 million house is now worth $200,000.
Yeah. You'd be Tom, in 30 years, that house is going to be worth $300,000. You go, Steve, you're dreaming, it'll probably be worth closer to $3 million. But it's that.
Yeah, I'll take 5.
I'll give you $550 cash. But you see what I mean? What I'm saying is you just can't imagine it being that bad. But like I say, this is, none of us picked COVID. No one in 2015 went, you know what, I reckon there'll be a raging, global pandemic and they'll lock us in our rooms for 6 weeks. People going, oh, mate, don't be stupid.
Look, that leads us to the short story. about
Oh, yeah.
the little cold that's going around.
Yes. That's
I'm just
getting
trying to fire you up, Steve.
They're getting worse and worse. I'm just trying to warn people that you've got to be careful with this stuff, right? This is not even a black swan, but this is one of those events, and I'm deadly serious here. Get on and read stories about people who are suffering from long COVID. It's ugly, right? And we don't want it to think that it can't happen to us, right? It's like smokers. Everyone else gets lung cancer, not me, right? Alcoholics, everyone else has got a problem, not me. And that's what I'm saying to people. You know, like you've got to look at those. This is the Talebian stuff of saying it's not about the averages, it's about the consequences, right? The average person gets COVID and, mate, they're okay. Okay, which one of the averages are you? Are you the person that went, I got COVID, had a sniffle and I was fine? Or were you on the other side of the average, which was, I've got long COVID, I'm debilitated and I can't work? And I don't know if you know, but in America, they're now cancelling conferences because companies are saying, we're not coming because of COVID.
No, I didn't know that.
Yep.
Because it feels like we're all turning a pretty blind eye to it over here, to be honest.
Tom, we are, right? It's only if you're paying attention that that's why I'm putting these stories in. I don't like putting them in, but what I'm trying to do is, I think it's remiss of me if I said, oh, yeah, mate, I could have told you that 6 weeks ago that it was raging through the joint. Your argument should be, well, why the hell didn't you? And it's like, oh, well, I haven't had COVID, so, I'm all right. Well, I think my job, and I think all of our jobs, is to say, listen, we just need to be aware of this thing and be very careful, because what we're understanding is the more we're looking at, the worse we're going. This thing's given people memory losses. People are forgetting a lot of stuff. There's something like, I think I mentioned it a few weeks ago, there's 2.5 million people in England who can't work, right? Like what I'm saying is they're now getting to it going, hang on, as if demographics aren't bad enough, we've now got, people dropping out of the workforce. They've got it in the United States.
Yeah, I mean, for me, we talk about it a lot. We make people aware that this is a reality. But what do we want people to do? 'Cause it's difficult, right?
Well, I'm just trying to let people know that you've got to think of these things.
It's actually starting to look quite serious.
Well, yeah, but as an investor too, right? I don't like to be cold-blooded, but it's a bit like, guys, this is going to affect your investments, so you really need to sit down and think about it, right? And that's another point that I want to make, which is, as I think I've said there, investors will need to understand how COVID and its impact affects companies and employment. Over the next few years, governments are really going to have to choose where capital funds get allocated. And what I'm saying there is that you can't have COVID raging through the community and have the government go, not our responsibility, right? You can do that when 10 people are sick. You can do that when 10 property investors lose money. You can't do it when 2 million people get sick. You can't do it when 2 people lose money. That's when you go, okay, now it's a political problem. Mm-hmm. Okay, and I can tell you that's what happened in the GFC, right? In COVID, when it first hit in 2020, remember, the government didn't go, look, let's have a look and put a bit of money into the economy. Right? They went, listen, we've got to go gangbusters on this. Why? Because there's 26 million Australians who are affected. We've got to give them all money. Right? And we were fortunate in that sense because it held up the economy. Right? You imagine if the government had went, we're about a government surplus. I mean, it would have been a bloody disaster. The reason why the American economy is booming is because they absolutely spent a bucket load in COVID. Right, and all the poor people got more money and thought, this is great, right? Because for once they could go out and buy stuff, right? And that's why I'm saying that affects your investments. If, for example, you're invested somewhere in, say, manufacturing, and then they get COVID runs through the joint, and the workers all go down, right? And the workers are the key parts of what they call key person risk in a company, right? God, don't let bloody Tom get sick, because if he gets sick, it's all over Red Rover, right? Berkshire Hathaway with Warren Buffett, right? Key person risk, right? And that's what I'm saying. If Tom and 30 of his engineers get crook and you go, mate, if they come in, they're going to infect more and more people. At some point, you say, "Well, hang on, how are we going to deal with this?" Oh, we haven't got a contingency plan. That's where you go, "Oh, Jesus, this is a bit." And you're not going to rush out and tell everybody, are you?
No.
You know, that's why I'm saying they don't print the COVID figures anymore. There's not much talk about it. You hardly ever see anybody wearing a mask. You know, we're all just bowling along as if nothing's happened.
It's blind.
Head in the sand. Yeah. Look, just finishing up on the chow. We've got a nice chart here. It just reflects the one we use in our World 2 strategy on capital cycles. And it's important to watch the capital cycle as it can be a leading indicator of industry dynamics over time. And we got a little clip here which says Google says AI is magic and businesses are finding out it isn't. And only 5% of companies in the US are using the technology.
Yeah.
Well, that's surprising to me. The 5% will be the magic 7.
You're the
right?
5%.
You're one of the 5%.
One, yeah. The 5. Well, that'll be
5%, mate.
that'll be the Mag 7, right? So Microsoft's, your Google's, your
Yeah.
Nvidia's. They're all using, and no one else is using it. So
Varying levels, right?
yeah,
That's an interesting stat, given that is absolutely, that's the story at the moment of the stock market, right?
Yeah. What I'm trying to point out there with the capital cycle is this is exactly what happens. Remember 5 years ago, we were all talking about buy now, pay later. Remember that? It was all, what was that company? Afterpay, Zip Pay, blah, 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 right? Capital cycle. What happened? They all spent like crazy and then it collapsed, right? Lithium goes up and now it's, now they're going, there's an oversupply, right? And so every cycle, this is happening and it happened in the internet, right? The internet's going to change the world. Everyone piles into the internet and then it collapses, right? Oh, actually, we decide it's not going to change the world. So I suspect the same thing is happening with AI, which is AI is going to change the world. Okay, maybe not, right? Because you get this.
Maybe it objectively will, but
Why?
not. Huh?
Tell me why.
Mate.
Tell me why. You can't. That's
Just put me on the spot.
No, but that's what I'm saying. It's the same thing happened with the internet in 2000. No one's going to go shopping anymore. No one's going to be watching movies anymore. Blah blah blah.
Wait, can you really argue that the internet didn't change the world? Because let's be honest, we'd all be pretty screwed without it right now.
It did, Tom, but not at the bloody price you paid for it. Right? That's Sun Microsystems, like we said last week, where he was going, what the hell were you thinking? 10 times sales. NVIDIA's at 39. Right? So you have to say to yourself, okay, Tom, tell me why NVIDIA's worth 4 times what Sun Systems was, which 25 years ago was batshit crazy expensive. And now...
Oh, yeah. I'm not arguing that. I'm saying the technology is useful. I'm not saying the valuations are justified.
Yeah, but that's what I mean. They go hand in hand. You see, because what people do is say, how do I justify this valuation? Mate, AI is going to change the world. Okay, maybe. But that's what I'm saying. The benefit of the internet was when the internet bubble blew up, the benefit was we had all this really cheap infrastructure. Right, and that's why the internet actually expanded more and more because the infrastructure was cheap. In 1995 to 96, it was really expensive because it was in the capital phase.
Yeah, it was new.
And why was it in the capital phase? Because everybody was going, it's going to change the world. Yeah, so, that's what I'm pointing out there is if you look at it, that AI, we are in that capital cycle where everybody's talking about AI.
Yeah,
right?
and there'll be a few that survive.
Exactly, Tom. There's 100 companies and guess what? There's room for 6.
Yeah.
Okay, so which of the 6 that make it? I got no idea. All right. And what we say and what we coach people is just let it blow up first, then look at who the survivors are, right? Then you can go in and...
Start investing.
Yeah. Well, look at lithium, right? There's been this explosion. It's now going to decline. And I can guarantee you 6 to 12 months will probably be the time to say, okay, now I'm going to have a start looking at lithium because what it's done is it's weeded out the dead ones, the weak ones, right? And so what you're left is with an equilibrium of maybe, 3 or 4 companies, for example, in Australia, where you're then able to say, I think about lithium and people will go, oh, Tom, Jesus, lithium's terrible. It's been dead for 5 years. That's when you want to buy it. right? That's when you want to say, okay, well, now's the time to get into it because there's actually not much competition.
Yeah, and you'll jag the company with the competitive advantage that pays a dividend, that's cheap, that's productive.
Exactly.
That,
exactly.
Perfect. All right.
There you go.
We'll wrap it up there. We're getting a few comments, so especially on the socials, saying how can we read these documents? There's a few hundred listeners each week now. Go to totalmoneymanagement.com.au. It's called The Week That Was. It's free to sign up, but I'm sick of responding to people. So if you're listening, just go and sign up.
For God's sake, get the website, will you?
All right. Thanks, guys.
Jeez, mate, you're a good salesman, aren't you?
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.